An even bigger threat is to the dollar and to our currency. I follow Jim Grant. I think he's one of the smartest guys out there, looking at the economy and the Fed. He thinks we're due for interest rates, high interest rates for a long period of time, but we're accumulating debt at $1 trillion every 3 months now. This is an extraordinary thing, and interest rates are now becoming the highest or one of the largest items in our budget. People can talk about wanting to help other countries. We don't have the money. It has to be printed up. It's destroying our currency, and it's why it costs more to go to the grocery store to buy your groceries. There is a possibility we could go too far with this, and we could have a cataclysmic economic downturn, recession, depression, destruction of the currency.
Wow, harsh words there from Kentucky Senator Rand Paul. He joined me on Sunday Morning Futures on the threat to the U.S. dollar, our currency, and his work with Jim Grant. Take a look at futures right now. Dow Industrials at the highs of the morning, going into the CPI number out in about 5 minutes' time. Dow up 114, the Nasdaq up 48, and the S&P 500 higher by 8.25. Interest rates, meanwhile, are pulling back today. The Treasury's 10-year yield down 5.5 basis points, sitting at a level of 4.181%. As the Federal Reserve kicks off day one of its last monetary policy meeting of the year, the Fed is expected to hold rates steady for the second consecutive month, with a pause announced tomorrow. Joining me right now to get in front of it is Grant's Interest Rate Observer founder and editor, Jim Grant. Jim, great to see you. Thank you so much for being here this morning.
Thank you, Maria.
Senator Rand Paul just mentioned you in his comments.
Wasn't that nice?
Yeah, that was very nice. Congrats. He's particularly of interest of your comments on the dollar and inflation today and $33 trillion in debt. Your reaction?
Well, I think the thing to keep in mind with regard to inflation, Maria, is whatever this number we're about to see reveals, inflation is, importantly, it's not transitory. It is permanent in that you never regain the purchasing power you have lost to inflation. There's no such thing as deflation in modern monetary life. So the political significance of this number is going not so much that it's going to be up 0.1% or 0.2, or the core might be up 0.3 or yours. The important thing is that the loss of purchasing power since 2020 is in the low teens, and that is not going to be recaptured. And that's, I think, what the political significance of this number is.
So do you see a threat to our currency, the dollar, Jim?
Well, the currency has been on a long slide with respect to its purchasing power, for example, in gold bullion. That is a design feature. It's not so much a fluke. The Federal Reserve is targeting a loss of purchasing power on the order of 2% a year. So we live in an age of inflation. The question about the dollar is, what is the next best thing? And compared to the competition, the dollar looks pretty good on the international stage. It does not look so good with respect to purchasing power at home, nor with respect to the long-term decline in gold value.
Yeah, it's a really important point that our interest payments are soaring, and it's only getting worse the higher the debt goes. But, Jim, what do you think the Fed does at this point? Where are you in this debate about rate cuts next year?
I think that Chairman Powell is still mortified at the Fed's failure to identify the upsurge in inflation that began in 2020 and 21. And the last thing he wants to do is declare a preliminary and premature victory. So I think that the Fed, much to the disappointment of the speculators who are banking on an early reduction in the funds rate, I think the Fed is going to reassert its determination to see the rate of inflation as measured fall to the order of 2% rather than, say, 3 or 3.5. So I think the Fed will begin cutting, but only gradually and only later than the market is hoping.
Well, I mean, look, we're waiting on this inflation number. We're expecting year over year to be up 3.1%. But even when you look within this report, some of these components are still quite elevated, like shelter and food and even oil.
Yes, well, that is the nature of the modern monetary system. In the day, in the first 150 or so years of the United States, there would be periods of rising prices followed by periods of deflating ones. Often the deflation was a benign kind in which real wages actually rose. But at the end of a long-dated period, whether it be a century or a century and a half, the purchasing power of the dollar was essentially unchanged over that long span of time.
Right.
And what is different since the last half century or so is that there is a ratchet up, but never a compensating move down. So that's why people, I think, are less moved by the rate of change in inflation than the level.
Let's get the number. Cheryl Casoni with the CPI right now crossing.
Here we go. We're going to just go in line here. Okay, month over month for November, the headline number, the estimate was it was going to be flat. It actually jumped 0.1%, so up 0.1%. Year over year, the headline number for CPI in line at 3.1%. And remember, this is down just a fraction from last month's read of 3.2%. So again, 3.1% to the upside, in line year over year. Now to the core, that also came in line, jumping 0.3% with estimates. A gain of 0.3% was the estimate there. And then in line for the core year-over-year number, up 4%, which is actually the estimate and also the read that we got last month as well. Really quick, I want to jump into earnings. We've talked about wage inflation, Maria. Real average weekly earnings jumping 0.5% in the month of November. We are seeing really quicker. I want to mention U.S. short-term interest rate futures have risen after the CPI report. As you can see, we've got about a 50-point jump right now on futures. Okay, energy prices down for the month, Maria, down month to month 2.3%. Food prices a little bit of a jump, 0.2% higher. And then going down to housing, we actually saw a little bit of a bump in housing month to month of 0.4%. And then also that owner's equivalent of rent of a primary residence, that jumped 0.5%. That's rent. Again, so those are rises. Look, these are rises month to month. This is adding to a rise year over year. Gasoline, we know this, but gas prices in the report down 6%. New vehicle prices down 0.1%. And again, I mentioned energy down 2.3%. So again, negative there. But again, those average workers, those real average workers, those wages up 0.5%. Remember the month prior, that was down 0.1%. So we saw, real earnings go down 0.1%. They just jumped 0.5% for the month of November, Maria. Going into the report itself, I'm just going to give you a quick headline and send it back to you and to everybody, of course, for reaction here. But I do want to say, I want to see what the government is actually saying as to why we saw this jump in the report. And my computer is stuck, so I'll send it back to you. Oh, here we go. All right, really quick. They're pointing to shelter again. The index for shelter continued to rise in the month of November, and that was the offset of the decline that we saw in the gasoline index. They mentioned the energy index that fell as well. So I'm going to start going through all the different components of this and send it back to you. But those are the numbers, Maria.
Thank you so much, Cheryl. Yeah. Jim Grant, what's your initial reaction here? You got food up, you got housing up, you got wages also up 0.5%. Your reaction?
Well, I think this inflation is, if not intractable, is going to be hard to push still lower. The financial backdrop to this is interesting. The Chicago Federal Reserve's own index of financial conditions, so it's very accommodative financial conditions. So the Fed has been tightening, but arguably the Fed is not yet tight. And I think what is forestalling a genuine tightening move of the kind we saw, for example, in the Volcker years, is the heavy leverage that is prevalent in corporate America. The near decade of 0% interest rates instigated a lot of financial engineering that has induced a great frailty in corporate America, especially in the private equity area. So it's a difficult thing for the Federal Reserve to navigate this. I mean, they deserve the difficulty, to be sure. Yeah. But if you tighten too much, that is a problem. If you don't tighten enough, that too is a problem. Yeah.
What an incredible snapshot in time, Jim, to create Grant's Interest Rate Observer and follow these markets during these last 3 decades. Really an incredible moment in time to actually navigate. Congratulations on that 30 years.